Welcome, folks, to a deep dive into the timeless principles of intelligent investing. It's about thinking like a business owner, not a gambler. It's about understanding the true value of a company, not just the price of its stock on any given day. So, buckle up, grab your thinking caps, and let's explore the world of intelligent investing together. We're going to talk about everything from margins of safety to Mr. Market's mood swings. Remember, this isn't about getting rich quick. It's about building wealth steadily and sleeping soundly at night. Now, let's start by drawing a clear line in the sand between investing and speculating. Investing is like building a house. It takes time, careful planning, and a solid foundation. You analyze the business, look at its earnings, its management, its debt. You get a good sense of what it's really worth. Speculating, on the other hand, is more like playing roulette. You're betting on which way the wheel is going to spin, hoping for a quick win. You might get lucky in the short run, but in the long run, the house always wins. That's why we focus on investing, on buying pieces of great businesses at sensible prices. We're not looking for a quick buck, we're looking for long-term value. Wise words to live by, folks. Wise words to live by. Now let's talk about one of the most important concepts in investing: the margin of safety. Even the best investors in the world make mistakes. That's why we buy stocks with a margin of safety at a price significantly lower than what we believe the business is worth. This cushion helps protect us from those inevitable mistakes. Think of it like this: you wouldn't buy a car without brakes, would you? Well, the margin of safety is like having a good set of brakes on your investments. It gives you room for error, a buffer against the unexpected. So always look for that margin of safety. It's your best friend in the investing world. Now, let's talk about another important character in our investing journey: Mr. Market. Mr. Market is a fictional fellow, but he represents a very real force in the stock market: emotions. Mr. Market is moody. Some days he's optimistic and euphoric, driving prices up to unreasonable heights. Other days, he's pessimistic and depressed, sending prices tumbling down. But here's the thing: Mr. Market doesn't set the true value of businesses. He just offers you a price, and it's up to you to decide whether that price makes sense. Don't let his mood swings dictate your investment decisions. Instead, take advantage of his irrationality. When Mr. Market is feeling down, that's your chance to buy great businesses at bargain prices. And when he's overly exuberant, well, that might be a good time to sell. Remember, be greedy when others are fearful, and fearful when others are greedy. Stay rational and capitalize on Mr. Market's mood swings. Now, let's talk about the different approaches to investing. Benjamin Graham identified two main types of investors: defensive and enterprising. Defensive investors prioritize safety and stability, looking for investments that will provide steady, if unspectacular, returns. They're content with letting their money grow slowly and steadily over time. Enterprising investors, on the other hand, are more willing to roll up their sleeves and dig for bargains. They spend time researching companies, analyzing financial statements, and looking for hidden gems that the market has overlooked. The best approach for you depends on your individual circumstances, your risk tolerance, and your investment goals. The important thing is to understand the difference and choose the path that aligns best with your own financial personality. Now let's talk about diversification. You've probably heard the old saying, "Don't put all your eggs in one basket." Well, that couldn't be truer in the world of investing. No matter how much research you do, there's always the risk that something unexpected could happen. That's why it's crucial to diversify your portfolio. Don't put all your money into just one or two stocks, no matter how promising they may seem. Instead, spread your investments across different industries, different asset classes, and even different geographic regions. A well-diversified portfolio is like a sturdy table with multiple legs. Now, let's talk about one of the most fundamental concepts in value investing: intrinsic value. The price of a stock is what you pay for a tiny piece of a company on the stock market. But the intrinsic value, that's what that piece of the company is truly worth. Think of it like buying a used car. The sticker price is what the seller is asking for, but the intrinsic value is what the car is actually worth based on its condition, mileage, and features. Figuring out a company's intrinsic value requires analyzing financial statements, understanding its competitive landscape, and making educated guesses about its future earnings potential. We want to buy stocks when their price is significantly lower than their intrinsic value. That's where we find our margin of safety and the potential for market-beating returns. Now, let's talk about the two main asset classes in most portfolios: stocks and bonds. Stocks represent ownership in a company. When you buy a stock, you're buying a tiny piece of that business. Bonds, on the other hand, are like loans that you make to governments or corporations. Stocks tend to be more volatile than bonds, but have the potential for higher returns over the long term. Bonds are generally considered less risky and offer more stable returns, although typically lower than stocks. How do you decide how much of your portfolio to allocate to each asset class? It depends on your individual circumstances, your risk tolerance, and your time horizon. Finding the right balance is key to a well-rounded investment strategy. Now, let's talk about two of the most important factors to consider when evaluating a company: earnings and dividends. Earnings are the profits that a company generates from its operations. Dividends are a portion of those earnings that a company chooses to distribute directly to its shareholders. Think of it like getting a regular paycheck from your investment. Not all companies pay dividends. Some prefer to reinvest all of their earnings back into the business. But for those that do, a long and consistent track record of dividend payments can be a sign of financial strength and stability. It's like a company saying to its shareholders, "We're doing well, we're generating profits, and we're happy to share some of that wealth with you." Now, let's dive a little deeper into the world of value investing and the art of finding undervalued stocks. Value investors are like detectives, constantly searching for clues that the market might be overlooking. We pore over financial statements, study industry trends, and talk to company management, all in an effort to uncover hidden gems, stocks that are trading for less than their intrinsic value. Finding undervalued stocks takes time, patience, and a healthy dose of skepticism. But when you do find one, the rewards can be substantial. Now, let's talk about market cycles and the importance of understanding the ebb and flow of the market. The market doesn't go up in a straight line. It moves in cycles, periods of expansion followed by periods of contraction. Think of it like the tide coming in and going out. Trying to time the market perfectly is a fool's errand. But understanding market cycles is essential for long-term investing success. It helps you stay disciplined when the market is getting ahead of itself, and it gives you the confidence to buy when everyone else is selling. Remember, in the words of the great John Templeton, the time to buy is when there's blood in the streets, even if it's your own. Now, let's talk about some of the common pitfalls that investors should avoid. Even the smartest investors make mistakes, but the key is to learn from those mistakes and avoid repeating them. One common mistake is getting caught up in the hype. It's easy to get swept away by the excitement of a hot new stock or a promising new technology. Another common mistake is trying to time the market. As we discussed earlier, trying to predict when the market will go up or down is a losing game. Avoid letting your emotions guide your investment decisions. Now, let's wrap up by talking about the importance of emotional discipline in investing. Investing isn't just about crunching numbers and analyzing balance sheets. It's also about mastering your emotions. The stock market is a roller coaster. There will be ups and downs, twists and turns. But remember, the market rewards patience and discipline. It punishes those who make impulsive decisions based on fear or greed. Develop emotional discipline by having a sound investment plan and sticking to it, even when the going gets tough. So, there you have it, folks. Remember, successful investing is about patience, discipline, and a long-term perspective. It's about understanding the value of a business and not being swayed by the whims of Mr. Market. It's about buying when others are fearful and having the courage to hold on for the long ride. So, stay informed, Stay rational and happy investing.